So this brings me to the next segment, which is ease of entry and exit. And this is another very underappreciated indicator. How easy can you get in and out of your position? And you need to think about this again before you take the actual position. So, what is your position size going to be in relation to the average trading volume of the stock? If you take a 20,000 share position and the average volume is only like 5 or 10,000 a day, you're going to be the whole market, more than the market. And that's going to lead to a lot of bad pricing and an inability to get out if you ever need to. Also, what is your position size in relation to the current trading volume of the stock? Too many people make the mistake saying, "Oh, Tim, why are you trading this stock? The average daily volume over the past month, over the past year is so low." I don't care what the stock normally trades. I care about what the stock is trading when I'm looking to trade it. You have a lot of these companies that normally trade 5, 10, 20, maybe 50,000 shares a day. So it's very illiquid stuff. And then when there's a catalyst, if they say they're going to be on TV, if a billionaire invests, if they have an earnings or a contract win, and they're trading 1 million or 2 million shares that day. So think about that. Don't just think about what is the average daily volume. Also, how fast is the stock moving so that you can get in or out, without chasing too much. Sometimes I chase, especially in this current market. It pays to actually chase these morning spikers because they can go much further than you think, like we saw on MDGS a little while ago. But I don't like chasing too much because, you risk losing more if you're chasing too much. You don't know when it's going to top out. And then also when you're shorting, you have to think about, are there going to be enough shares available to short? Is the stock under the SSR, which is the short sale restriction, which means you can only get in on an uptick, not on a downtick. So a lot of people, well, some people are surprised sometimes by how quickly I short, like near the market open. And they say, "Tim, why are you shorting? Don't you want to give it more time? Like wait for some volume, wait for the pattern to show itself?" And for me, a lot of these stocks that I want to short, if you wait, you cannot find shares to short later. So you can criticize and say, "Oh, you're too early." But if you're trading with a small account, which is what I'm doing this year and which is what most students are doing, you have to be very particular when you can get in. If you're trading with, 500,000 or 1 million shares, you can pretty much short these stocks if there's going to be borrows whenever you want. At these higher priced brokers, they have more features, but they require a lot more trading and a lot bigger minimums than most people can handle. So while I'm trading with just interactive brokers and E-Trade, the shares are first come, first serve. So if I'm shorting, I have to consider that again before I short. And the SSR, the short sale restriction, if a stock is on the verge of collapse and there's not going to be any upticks, you're not going to probably be able to get into your short position when it starts fading and dropping. So you need to maybe go in a little early and try and get in and risk a little pain, in case it upticks a little bit before you actually want, but at least that way you ensure your position. You got to think about this stuff. Most people don't. They just think, "Oh, buy or short." It's not that simple. I never, 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 never want to take such a sizable portion of the trading volume, though, that it makes it tough to get in or out of the stock. I prefer stocks that trade 500,000 shares to 5 million shares per day. You can even go down to like 200 or 300,000 shares, but I do not like the stocks that trade 10, 20, 30, 50 million shares a day. They're too choppy for me to control my risk. And frankly, I have patience problems as it is. So if a stock is going to be that choppy, I'm just going to exit, and I usually screw up. You have to know what you're good at. I know plenty of traders who like those ridiculously liquid stocks. For me, what I'm really good at is buying or shorting 1,000 to 5,000 shares at a time, and I don't want to be more than 1% of the daily volume. And again, this is the daily volume that I'm actually trading it, not the average daily volume over the past month or 3 months. I was once the #1 ranked trader on Covestor before they changed up their rules a little bit, and Covestor got into the business of allowing other people to copy your trades. And I was the #1 ranked trader on Covestor. Everybody wanted to copy my trades. And, I'm not a big believer of copying anybody's trades. I want you to learn on your own. But that was their service, and we tried it. It was through Interactive Brokers, which is one of the brokers I use. But the problem with the Covestor system, funny enough, was that it would not replicate any stocks if the average daily volume was too low over the past 3 months. And I'm like, I don't care what the volume was 3 months ago or 2 months ago. I care about this stock that's trading today. So all my most successful trades would not be replicated. Also, there was a time delay where, I like buying or shorting before the market closed and then covering or selling, exiting my position the next morning. Sometimes there was a time delay if Covestor could not find the shares to short. So while I'm actually short in the afternoon at, like, let's say 3:45 p.m. Eastern, and then I'm covering the next morning at 9:30 a.m. Eastern, Covestor, with its robotic auto copying wannabe strategy, wouldn't short it on the first day, and then they would find shares to short the next day right as I was covering. So it was totally screwed up. And basically what I learned is that you have to learn this strategy and do it manually. Robots and auto trading is just not there. The rules are not ready for this. So in the past, I have gone too big with my positions. I once upon a time wanted to be a giant hedge fund manager, and I tried to, grow my fund. And frankly, I just wasn't very good at taking those big positions, again, because I'm such a coward trader. And I admit it, I'm much better with my smaller positions and trying to take the meat of the move. And that's frankly why I teach, because the strategy that I'm really good at is the strategy that fits, most of my students' account sizes. Most of these stocks can really move too fast. And I missed out when I take such huge, huge, huge positions. So this is what I do. I aim to make 25, sometimes 50, sometimes 75 cents a share on a few thousand shares. So it adds up. You can see my profits over time. You can see all my trades, but over time, I'm making 500 here, 1,000 there, sometimes 3,000. Sometimes I lose 500, but overall, this is my main, bread and butter. This is my sweet spot. And you have to find your own sweet spot. I know a lot of people who would be very happy to make $500 per trade, and I know a lot of people who spit on $500 per trade. For me, I do what works best. I did not choose this. This chose me, and I adapt. I'm reactive. If I had my choice, I would love to manage, a multi-billion-dollar hedge fund. I'm just not that great of a trader. And my patience or the way that I learn things just doesn't work that well. Tim Grittani doesn't even look at his dollar profits per trade. He lets the chart play out. I don't have that discipline. So I'm not going to try to be somebody that I'm not. I'm not ashamed of that. I'm not embarrassed. I've just learned what I'm good at. And what I'm good at is different than what a lot of people are good at. But you also have to remember, with ease of entry and exit, buying is easier than shorting. That's why literally 99% of the trader world buys and does not short. Shorting has been called unethical, un-American, difficult, risky, any bad word you can think of. Because shorts are dependent on finding borrows from their broker in order to execute the short sale. For those of you who don't know, short selling is, you're basically betting against the stock. You're taking a negative position. And that freaks people out, because they're like, how do you take a negative position? Normally you just want to buy 1,000 shares and then you sell 1,000 shares. That's a good stock trade. You buy it at 5, you buy 1,000 shares at 5, sell 1,000 shares at 7, you make $2,000. Pretty simple. Well, with shorting, you have to take a negative 1,000 shares at, let's say, 7, and then you're trying to buy it back at 5. It's the exact same trade, just in reverse chronological order. And this freaks people out. I have a whole DVD called Short Stocking. It's 6 hours, describes everything I know about short selling. But long story short, in order to take the negative position, you have to get a borrow from your broker. And, you have to call up your broker. Some brokers you can message them. Some brokers you can just, try and put in the order, like I do with E-Trade. And if it allows me to put in the order, they have shares to short. If they don't, I don't get it. Interactive Brokers, I think there's a way to call into. I don't know. For me as a teacher, it does me no good if I find a borrow and none of my students do. Then they're just like, what kind of strategy are you teaching, Tim? Only you can do it. and no one else can. So I don't really want to short sell these impossible to borrow stocks, even if they are going to drop, because for me, my priority is teaching. And it does me no good whatsoever to make money on a trade when all my other students are just confused and they're like, well, this stinks. And it discourages them from studying. So oftentimes there are no or minimal shares to short. So again, if there are shares available and a lot of shares available, I sometimes enter early and I risk some losses just to ensure my borrow and take my position. Sometimes even when I do reserve my borrow, the broker stops loaning out any more shares. And, worse, they can call back the shares that they've already loaned you. That's called a buy-in. And usually it's, T plus 3 days. So you can short it. And then even if your shares are going to, get bought back in, it'll be 3 days later. So you have 3 days to try and see if the stock is going to drop. But I've had accounts with brokerages like SureTrader that I no longer use because they bought me in the same day on my short. And I can't short with brokers that buy me in on the same day. That's just crazy. What if you're off by a day on when you think the stock is going to drop? I've never heard of that, but I saw it firsthand with SureTrader. That's why I don't use them anymore. I do not use any offshore brokers. I don't think that you should. I don't think that you should use small brokers. I don't think that you should use hedge funds or prop firms. There's a million different, brokerage schemes out there. I'm sticking with the big boys, Interactive Brokers and E-Trade. As I said earlier, I think winter is coming for the brokerage industry. So even though I might get less borrows, my money is safe. The money, I'm a U.S. resident, the money is insured. SIPC insurance insures me. If you're an international student, which I have a ton of, Interactive Brokers accepts most countries. I'm sorry that their minimums aren't lower. I don't make the rules. But apparently if you're under 26, Interactive Brokers allows just a $3,000 minimum. So call up Interactive Brokers. But there's a lot of brokers out there. This is just for shorting. Long story short, you must consider how hard it is to short a stock and the risk that you won't be able to enter a short or get back into your position later. Let's say you do short a stock and you're all excited and, maybe you're cutting losses because it doesn't go your way and then you want to get back in, but you can't. So you have to think about that before you exit your position. Sometimes I risk a few more dollars because I know I'm not going to be able to get back in. And the shares that I've reserved are a gift. So I have to risk some because if I'm shorting a blatant pump and dump that's probably going to crash or get halted by the SEC or get an expose, but something very negative is about to happen, well, I want to have my position as long as I can. That's not to say that I'm just going to risk infinite losses, which is the risk with short selling. I am going to cut losses quickly, but I'll give it a little more time. I'll give it a little more leeway just because I know how hard it is to not just get an initial short, but to get back in if you've already covered your first short. So you have to consider this. You have to consider this. You have to consider this and think about this before you enter. Stock trading, especially shorting, is not as simple as you want it to be. This is where planning comes in. Also, past performance and history of running. This matters so hugely. Has the stock spiked big or has it been volatile in the past? If it has spiked, was it able to hold that spike for very long or did it just spike and fail quickly? These stocks kind of have personal characteristics and memories. So if a stock is able to hold its spike in the past, it probably can hold its spike again in the future. But you also have to consider, what does the long-term stock chart look like? Is it ugly? If it's a gradually downtrending chart like most penny stocks, aka if you've seen my penny stocking DVD, the crow, where this stock just keeps dropping gradually, picking away at your account like a crow, well then will the long-time suffering investors sell into any follow-up spikes? And the answer is probably yes. There's a lot of stocks out there that just drop very gradually and they can't break out of the, downtrend because there's so many long-term investors who are just selling into any spike. especially towards year end, where if you take your tax losses, if you take your losses before the end of the year, before December, you can take those losses on your taxes this year. So if someone's going to sell a losing position, they're going to do it in October, November, December. And if they're going to do it in October, November, or December, other people might do it in July, August, or September because they want to beat the rush of other people they know that are going to lose money. We know that 99% of people only buy. So the vast majority of people in any downtrending stock have gotten crushed. And it's just a question of, are they going to sell now or are they going to sell later? Are they going to hold and hope? A lot of people do hold and hope. But towards the end of the year, the benefit of taking a tax loss now so that you can pay less taxes come April, well, that's sometimes a big motivator to get people to sell now. Also, will big-time short sellers look at any spike as an entry to betting against this probable long-term suffering company that has promised so much and delivered so little over the years? You don't just have bitter long-term sellers, you have short sellers who are looking and saying, wait a minute, this company has always failed its spikes and it has a long-term downtrending stock. Let me just short into any spike and it's probably going to keep dropping. So when short sellers come in and enter the fold, well, they're going to sell because, again, taking a negative position looks like a short sale or looks like a sell. So you don't know if it's an actual seller or if it's a short seller. You just know that it's some kind of seller, and that's going to put more pressure on the stock anytime that it tries to spike. So you have to look at the long-term chart. You don't want it to be downtrending if you want it to spike a lot. But the good news, if the long-term chart or even the recent chart is uptrending, let me change this. Long-term, let me add short/long-term. I'm a trader. I'm even adapting here. Let me see this. What does the short term? It's not just long term. It's also short term. What does the recent stock chart look like? But if the short and long term chart, 1 month, 1 year, 2 years, 5 years, if it's all uptrending, well, how volatile has the stock been? Or has it been a boring gradual uptrend so that any big move now might seem excessive? You can poke holes in pretty much any stock spiking if you try hard enough. And if you can't poke holes in it with a chart or past performance or, based on the news or based on the fundamentals, well, then that's when the stock likely has legs where it can keep spiking. But the vast majority of stocks are going to fail. The vast majority of small companies are going to fail. So you have to look to the past as a guide to the present and the future. If the stock has spiked big and let's say gone supernova in the past, well, momentum traders who like to buy that and short sellers remember these former runners, these kinds of plays. They call them former runners. And guess what? Momentum traders are now more likely to buy because they remember the old spikes. Short sellers are more likely to avoid short selling, and they're going to be less aggressive because they remember the old spikes and they've been trained to be scared of the stock. So if the past performance is downtrending, there's a big kind of like undertow on the stock that's going to make it very difficult for it to come up. But if there's an uptrend, it makes it easier for the stock to spike. That's why I like buying uptrends. That's why I like buying stocks that are breaking out. Past performance guides traders to be better prepared. That's what it's all about. So don't you ever buy or short a stock without looking at the 1 month chart, the 3 month chart, the 6 month chart, the 1 year chart, the 2 year chart, the 5 year chart. I understand that these stocks are moving fast and you want to take a position, but you got to be thorough. The less thorough, the less meticulous you are, you're just hurting yourself. You're hurting your odds of success. Also, when it comes to past performance and history of running, shares outstanding and public float matter. As if there's enough demand for the stock, you must consider how much supply there is. I wanted to at first in college be an economics major. Then I took an economics class and I was so bored, I hated it. And I switched to philosophy, which I'm very grateful for. But I'm also very grateful that I did take that economics class because a lot of this stuff is supply and demand. Shares outstanding and public float matter. If there's not enough supply and constant demand, the stock price must rise in order to attract more sellers to accommodate the demand. This is the economics of stock trading. So I encourage you to learn about supply and demand. Shares outstanding are how many total shares of a company there are. So if a stock is trading at, let's say, $5 a share and there's 10 million shares outstanding, then you multiply the shares outstanding times the stock price to get the market cap. And the public float is how many shares can actually trade. The difference is that some shares are restricted and locked up by insiders. Remember, I went over that example with CLRH where the stock was up for 2 weeks on the promotional mailer, and then in 4 days it drops 88% when insiders could finally sell their restricted shares, and the restricted shares became unrestricted. So always, always, always look at what is the public float. And we have this figure on Stocks to Trade. You'll see some videos later on where I have the public float listed right in my watch list. Shares outstanding doesn't matter as much because you can have a lot of shares outstanding, but a lot of them might be restricted. But then if you really wanted to get into more in-depth research, you got to look and see when do those restricted shares become unrestricted. Usually it's 12 months or 18 or even 24 or 36 months. And they're all listed. The dates when they become unrestricted are listed in the SEC filings. Most people are just too lazy. They don't want to look at it. Most people don't even know to look at it. But overall, the public float is what matters because that is the tradable shares. That is what the supply of shares are. But if there's, let's say, 2 million shares in the public float, which I would consider to be a low float, and the stock is trading 4 million shares on the day, meaning it's already traded every share twice, you got to figure some people are going to hold on to their shares and they're going to take some of their shares out of the supply. And if there's still demand, meaning if there's still buyers for whatever the reason is, if it's earnings or billionaire play or, low float, low market cap play right now, if there's enough buyers and not enough supply, the stock price will rise. The stock price rises in order to attract more sellers. The stock price will drop if there's too many sellers and not enough buyers, because now they're lowering the price and it's like, a 50% off sale at JCPenney to try and get you to buy these ugly sweaters. So you have to try and think about the dynamics and the economics of this. I greatly prefer buying low float stocks because it doesn't take too much demand to really spike the stock given the limited supply of shares. Anywhere for me from 1 to 5 million shares is low float. But even a stock with, let's say, 10 million shares in the float might be considered low float if the demand and trading volume is enough. If a stock is trading 20, 30, 40, 50 million shares in a day, that's 2 to 5 times the total number of tradable shares in the public float. So you have to look how much of the float is trading in a day. You have to figure that even if it's trading 2, 3, 4, 5 times the total number of shares, some people, and by some, I don't know if it's going to be 10% of the holders, 20%, or more likely like 50% of the holders are going to hold on to their stocks. So even though those shares are not restricted, they're unrestricted shares and can be sold at any time, if someone is invested in the company and they don't want to sell right now, their shares get taken out of the supply. The supply is what can actually trade. And there is, a good amount of supply with these kinds of stocks because you have traders who are just, flipping. I know a lot of traders who buy 5,000 shares and then sell 5,000 shares, 2 minutes later. And so the shares are forever in flux. They're not in any one account. But as I said, shares outstanding multiplied by the stock price is the total value of a company. $5 per share times 10 million shares outstanding. Get this typo. Equals a $50 million company. So you also, besides supply and demand, it gets a little more complicated. You have to watch a company's market cap closely because, even though a stock price might be based on supply and demand, sellers will come out in force if a company's valuation gets too pricey. Maybe not in this current market where we've seen like KONE go from the 1s to the 9s intraday, but In the vast majority of market environments, stocks are not going to go from the ones to the nines in one day on no news. This market right now is a little crazy. So I don't like chasing. I didn't even want to buy KONE in the threes or the fours. I thought that was chasing. I didn't know it was going to go to 9. Um, I only watch big percent gainers. This is what I do. So I'm always trying to find a big percent gainer, but I don't want to chase the big percent gainer. You have to be very, 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 very careful because, like a stock like KONE, which I brought up a few chapters ago, you don't know when it's going to end. It could just fall out of bed all of a sudden. Right now, there's so much demand for these low flow plays. Everyone's always trying to buy the next low flow play. And even if a low flow play has spiked a little bit and then it dips, some people are looking to dip buy and sell on the next spike. It's kind of crazy. It's really crazy right now. But truly reasonable and logical valuations do not always happen in real time. This is such a tough lesson for so many traders, so many wannabe short sellers where they're like, this is crazy. This stock is up from the ones to the nines. It has to go down. It doesn't have to do anything. Okay, back in the bubble, I saw stocks, and I mean back in 2000, I saw stocks go from 1 to 20 in a day, 1 to 50 in 2 days. So don't ever think that there has to be logic and there has to be reason in the market, okay? Mania, hype, hysteria, manipulation can last longer than you expect. So it is very scary to short sell a low float stock because short squeezes can happen. And they have happened. KBIO, which was a big play, the other, I don't know, I guess this was a few months ago, and it was fundamentally a worthless company. So I was shorting it at around $2 a share. But after hours, news got announced that this guy, Martin Shkreli, who's now been arrested and charged with a ton of different crimes, but at the time, he just had money and he took over the company. And after hours, the stock went from 2 to 10 in like 2 hours. And I know a lot of people who were short. I was short. My first Millionaire student, Michael Good, was short. Did we lose our butts? No, because we followed rule number 1 about cutting losses quickly. Michael Good and I each lost a few $1,000s. It wasn't fun. It stunk. But I also know several ex-students of mine and non-students of mine lost 6 and 7 figures because they short sell without thinking about the risks. They short sell because they think that all these companies should go to zero and they're going to hold till zero. GTZ is what they call it. Good till zero. I don't want that. Okay? I trade scared. Low float stocks usually have a low market cap, under 50 to 100 million. And that sounds, big in the real world, right? Like $50 million company. That sounds amazing. But on Wall Street, that is pathetic. That's a pipsqueak. A small cap company, not mid cap, not large cap, a small cap company on Wall Street is valued between 250 million and 500 million. Anything less, and we're talking nano caps, okay? Most people don't even know the word nano cap. It's so tiny. Think about that. So when a 10 or $20 million company starts spiking, it can easily become valued at 20 million, 30 million, 40 million with the right news, short squeeze, or just even enough demand from the buyers. But it's far more difficult for a $200 million company to become a $400 million company based off anything short term because the valuation is so difficult to grow a bigger company. You have scale coming involved here. You can't just become a $2 billion company and turn into 10 billion overnight. There's certain kinds of logic and reasons. And if there is a $2 billion company that turns into a $10 billion company overnight, it's probably going to be very short term. But you do have to be careful. You cannot just say this $10 or $20 million company will never go up. I know a whole contingent of bitter, weird, wannabe, just wannabe celebrities and want to be important and want to have attention. And they think that the secret is that you should never buy these penny stocks and that I'm the madman for saying buy these worthless companies and that I'm a pumper. I just want to piggyback moves that can actually work. And all that negativity that everyone thinks that these stocks should never go up, well, guess what, you negative Nancy's? That doesn't work in the real world, okay? In the real world, the risk reward actually favors buying these low float, low market cap stocks, especially right now. And shorting is terrible, terrible risk reward, even if you are right fundamentally or logically. Be scared when you're shorting. Sometimes stocks can also break out of old habits though. As I mentioned, stocks have personalities. Well, sometimes personalities can change if there's the right news, if there's the right setup, but it is tough. You'll learn that the stocks that have personalities and they trade a certain way for a day, a week, a month, a year, a decade, they're not going to change all of a sudden unless there's some really groundbreaking, news, which could happen, but it doesn't happen very often. Usually stocks that have spiked in the past only to fail quickly will fail quickly again. Let me put that in there. Not just fail again, will fail quickly again. The same exact way. It's no different. My fiance loves watching Law and Order. And you see these criminals, and I know it's a fictional show, but it's based on reality, and I know this from crime stats. If you're a criminal, the chances are you will probably commit the crime again. I'm not saying that you have to. I'm not saying that you even want to. But it's been proven that, criminals often become repeat offenders. Stocks, repeat offenders too. Maybe that analogy didn't work. And I have no problem if you're a convicted felon or, you have some kind of questionable past. If you study, you can make an honest person of yourself. I know I have a lot of students actually who do have some questionable past. I'm not trying to pass judgment on you. We all come from different backgrounds. I know life can be unfair, but through education, study, and preparation, you can do anything you want. And that's why I make guides like this. Remember, stocks that have gone full supernova in the past are more likely to go supernova again. It's their personality. Boring stocks in the past usually remain boring. And guess what? I hate boring stocks. They just don't move. There's nothing that I have against them. A lot of these boring stocks are awesome freaking companies. Very fundamentally sound, profits. They employ hundreds or thousands of people. They're real legitimate companies. But their stocks aren't going to move enough to make me want to trade them. So I stay away from boring stocks. I want to trade the biggest spikers so that even if I screw up on my entry or exit, which I usually do, remember, another typo. I'm gonna drink for every typo. I'm sorry, but if I screw up on my exits or if I screw up on my PowerPoint, which I'm gonna do, you have to anticipate that. There's still plenty of room for profits in the meat of the move. I'll make the analogy here. Even though I have a few typos, no one else shares this much information. No one else has this many millionaire students. So I expect you to forgive me for these small mistakes. I'm trying to get all this stuff out. You can hear I'm losing my voice. And it's the same thing with these big spikers. Even if I screw up on my entries and exits, like I did with TOPS the other day, selling way too soon, and SPU buying it in the 5s before it goes to the 20s and selling it at 6, which, hit my goals. I sell too soon, but that's okay because there is tons of room to profit. And those of you who have been my students long enough now see, wait a minute, Tim Sykes doesn't capture the whole meat of the move. Tim Sykes is not perfect. Tim Sykes refers to himself in the third person to make a point. So don't feel the need to be perfect if you're trading the right stocks with the right indicators and paying attention to the past. Let me give you a few examples. Let me show you what I'm talking about. Here is CDTI. This is a 2-year chart. Big spike right here. You had one green day and then it failed every single day. Red, 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 red. No follow-up spiking. I guess you had 2 green days here, but mostly red. Here you had one spike and it couldn't even finish up. Here you have one spike, it could not finish up. For those of you who don't know, this is candlestick charting, which you should learn. There's a great book by Steve Nison, Nison, and it's called The Basics of Candlestick Charting. And when you have a spike like this, the stock spiked from 12 up to 18, but it couldn't finish anywhere near there. At least on this spike, you can see the green candle, it finished near the highs. This means that even though it went to, actually it went to 16, it finished at 12. It could barely even finish up on the day. Same thing here. So you have 1, 2, 3, 4, 5, and actually another spike here, 6 failed spikes. This is the 7th try just this past week. I wasn't even tempted to buy it because it has 6 examples of failed spikes. And sure enough, this latest 7th spike failed also. But at least it tried to spike. You know, this might have a crow type formation chart and it might be gradually downtrending, but at least it does spike every now and then, which is all right. If you're a short seller, this stock is fantastic. All you basically have to do is short sell whenever it spikes because you know that it's probably not going to hold it again. Much better for shorts, not so good for longs, but much better either way than a stock like Groupon, which you'll see me analyze live in a video later in this guide. And look at this. I mean, this is a downtrending stock chart for the past 3 years, but worse than the downtrend is I don't see even one significant big spike. You know, this spike here from the 2s to the 4s, this took so long. I mean, this took, weeks to accomplish, just to double. And in this current market that we're in, we're seeing stocks double in a few hours or sometimes even in a few minutes with these low float, low market cap plays. I don't want to trade a stock like Groupon, and you'll see how this plays out in a little bit. Here's another example. This is probably the worst example, and I brought this up just because it's such a popular company and popular stock, and I need you to understand that you should never be trading it. This is Sirius Satellite Radio. This is a 2-year chart where it has gone from $3.30 to $4.30. So all of this work over 2 years, and the stock has gone up a lousy $1 a share. Now, granted, if you're a long-term investor, this is not bad. You're making 30% on your money over 2 years. That's very good, roughly 15% per year. But as a trader who needs volatility, and remember, I'm trading stocks, if you remember some of the charts I showed you earlier, they go from 3 to 4 in 5 minutes, or 3 to 4 in an hour, not 3 to 4 in 2 years. So this is why I'm not on CNBC. Yes, I also got kicked off because I brought some female models on last time and some people got offended. I'm sorry. I did not mean to offend anybody. I was just trying to make it a little more entertaining. Seriously, that's why I'm currently banned from CNBC. Kind of proud, kind of sad, but these are the kinds of stocks that they talk about nonstop. And it's good for long-term investors, but terrible, absolutely terrible for traders. Here's another stock, EVOK, which you'll hear me analyze. Even though this has a history of spiking, 1 spike, 2 spikes, 3 spikes, 4 spikes, and then a 5th spike, which is big. All these other spikes, this took like 2 days, 3 days, and then failed. This took like 3 days and then failed. This spike was just 1 day and then failed. This was a 1-day spike and it failed. 1-day spike and it failed. This was the first spike that actually succeeded. And this was right before the FDA news that just swatted down their entire life's work. And the stock dropped from 10 down to the 1s. This is a terrible, terrible pattern to buy. And you'll hear me talk about this. I call it, the bad sushi example. I got to resize this chart. Somehow it got bigger on me. You don't want to buy a stock that has this 80-90% drop. I know it's tempting. I know real life teaches you otherwise. When you see an 80% off sale at Macy's or something, you want to take it because the sweater that you're going to buy is going to be the same sweater whether you're paying full price or you're saving 80%. That's a good deal. But with stocks, when they drop 50, 60, 70, 80%, you don't want to buy them. It's like getting 50% off sushi late day. I'll tell you the story now just so that you remember it, but later on, I'll also repeat it. I lived in New York City once upon a time. Some of these little, grocery stores would have sushi and sashimi all day, and they would sell it, and it was good. But late at night, when there was unsold sushi, they would put out a little sign that says, sushi 50% off. And as a frugal person, a few years ago, not so much anymore, but this was over a decade ago when, frankly, I didn't have these rules and I didn't have that much money. I would sometimes take the 50% off sushi. I'm Jewish, okay? I like deals. I can't help it. It's in my genes. It's the way that I was raised. But what I learned the hard way is that sometimes that 50% off sushi will give you a very bad stomach ache. Not every time, not even most times, but if you're looking to save $5 or $7 on stupid sushi and you're risking to get a really nasty stomach ache or food poisoning, it's not worth the risk. Pay the full price so that you don't have to risk it. There's still a risk, with any sushi, but when you're getting old sushi that was made the morning of, that's just a risk you don't need to take. So with stocks like this, even though EVOK had a nice spike here, it absolutely failed, and now it is dead to me. And you'll hear more about this later. This is a stock chart that I greatly prefer, MGT, where, this stock was doing nothing. John McAfee, who created McAfee Software, joined the company as CEO. It's still debatable whether they're actually going to have any products and be a legitimate company. But when he got involved, they started issuing press releases like every day, pumping them out. It's debatable whether this is a pump. I mean, there has been some paid for promotion, but at the same time, you have this charismatic leader. You have a low float. The stock is trading 90, 100 million shares on the day. And when I say low float, I mean low float in reaction in comparison to how many shares are trading. When it's trading, 50, 60, 70, 90 million shares in a day, you see it go supernova. There's too much demand. And it comes down in here, and I was actually dip buying it here in the 240s. I got a lot of hate for this because people said, oh, this is a pump. How dare you, Sykes? You're buying a pump. You're just as bad as them. For me, I just thought that this could still bounce. As it turned out, it did. It doubled off of its lows. I did not hold the whole time. I sold for, I don't know, maybe 10, 20 cents a share. I sold way too soon because it didn't spike in the time period that I wanted. It was like another week afterwards. But what I learned, and the reason why I was buying, this is, first of all, a classic number 5 pattern from my penny stocking framework DVD. But more importantly, this had a nice uptrend and was a recent spiker. So when you have a nice uptrend and a recent spike and, it's basing, this is a 50% off sale off its highs, but it's very different than another kind of sale, okay? This kind of a sale where you have, big run up, or even if it didn't have a big run up, but the point is that you have a big gap down. So the news was that bad that the stock was down 80% and it held down there. MGT, yes, it's 50% off its highs, but it's just consolidating. Even though it's 50% off its highs, it's still up 6 times off its lows. So this turned out to be a very good dip buy point, and it's partially because it has a good chart. It has recent history of spiking. Here's another example, OPTT. This whole spike from the 3s to the 15s was made possible by this spike. Even though this spike failed, it went from the 1s to the 7s. And I know a lot of over-aggressive shorts who got squeezed on that day, thinking that, oh, it's up from the 1s to the 2s, let me short it. It's up from the 1s to the 3s or the 4s, let me short it. And they were the ones who allowed it to create this short squeeze to 7. And even though it regressed and, consolidated, people remembered here. And the short sellers who got squeezed here were not as likely to short here. So that means that there is less short selling. There is less selling, and that opens the door to a bigger spike here. And maybe the short sellers who were short in here, or who were going to short, and they didn't short because they're scared, maybe they started shorting, now I feel smart. Let me short at 9 or 10 because I missed this. I was wise enough to wait. And then they're shorting at 10 and then they still get squeezed, and then they're absolutely freaking out. So if you shorted too soon here, you're scared to short again. Then if you're shorting again, you're scared and you're trained to be scared, and you create this ridiculous short squeeze. So that's how to think of these, recent spikers. You want to watch and keep track of all these recent spikers. Here's another example, OPTT. This is a longer term chart. And this has a terrible long-term chart also, which normally I won't like. But it also, once upon a time, this isn't that very far ago, this is just a 3-year chart, it has gone up 5 times. You don't just see one failed spike or 2 failed spikes. You see one spike here, another spike here, a successful spike here, and another successful spike. So you basically have 2 failed spikes and then 2 successful spikes. And what I mean by successful is that it lasted for more than one day. This was a 1-day wonder and then it failed. This was a 1-day wonder and then it failed. But look what happens here. It puts together 2 green days back to back, and then it holds near its highs, and then it has another huge big green day. It never hit $65 a share, by the way. Part of the reason that you see these stocks up so much is because they do reverse splits. Their stock price has gone down so much that they can actually reduce the number of shares outstanding and increase the stock price. So if you have a $5 stock and 10 million shares outstanding and you do a 1-for-10 reverse split, well, the 10 million shares outstanding gets reversed to only 1 million shares outstanding because it's a 10-for-1 reverse split. And the $5 per share number now becomes a $50 per share. So it's the same exact thing. $50 a share times 1 million shares outstanding is a $50 million company. The exact same thing as a $5 stock with 10 million shares is a $50 million company. You have to stop paying attention so much to just the stock price. You have to think about what is the company value as a whole. So this never touched $65. I think this might have been at $6 a share or whatever. But the point remains is that whether it's at $65 or $6, it doesn't matter. It's still a successful stock spike. So even though you have this nasty downtrend, you must respect it. And if you don't respect it, it'll help you remember on one of these next spikes. As a short seller, you'll be forced to respect it. You'll probably get squeezed. You'll probably lose money early on. And if you remember this as a buyer, if you were one of the buyers here profiting, you'll remember it when it wakes up again. You'll say, oh, I remember 2 or 3 years ago, this stock was spiking. Let me keep this on the back of my watch list here because it might just pull this off again. There was no huge meaningful news. They didn't announce any revenues or any big contracts then, just like here. What's happening is supply and demand. Look at the massive volume. 10, 20 million shares in a day. And this stock does not have that big of a public float. So when you have, let's say 10 times the number of buyers as the number of sellers even possible, because there's only like a few million shares, the stock price has to rise. So I did not play this. I'm too scared, frankly. But I'm not surprised, and I'm scared a lot. I miss plays left and right, as you'll see. I don't mind that. There's so many plays, I don't mind missing a few of them. I don't fear missing out. I have no FOMO. But what I want you to get from all of these charts is that I want you to remember these recent spikes, whether they're, MGT, this spike was in May, and that this spike directly helped it spike in June and July, or whether the spike was 2-3 years ago. This spike helped this spike happen by training short sellers to be afraid and by training momentum traders to get interested. So that's what I look for. And I talk about this more in my Spikeability DVD if you want to watch that for some more background information. I'm kind of grazing over these points because this DVD guide is all about, including everything. This is a comprehensive formula, basically, where I'm trying to calculate the performance of all of this. And this is past performance, and I've rated it on a scale of 1 to 10 because it can influence the current stock spike or any attempted current stock spike. It's not always going to be 100% right just because the stock spiked, 3 years ago. Given this chart history and given how the company has really done nothing, it wouldn't have surprised me if this stock spike failed either. Okay, so I don't want you to think that this is a perfect indicator like, oh, it spiked 1 month ago or it spiked 3 years ago. It definitely is going to spike again. No, that's not what I'm saying. I'm saying, though, that in your analysis, if you look at these past recent spikes, whether they're short-term or long-term, they can play a role in the current spikes. And that's all I'm looking for. With all these indicators, I'm looking to try and judge everything that might play a role that will give me some better odds of success and give me some better insight into the current setup.
My name is Tim Sykes, and I teach people to trade stocks. I am a self-made multimillionaire.
So this is the ideal trade that I'm going to talk about. I want you guys to understand every single aspect of this trade.